We're here with Professor Sarah Quinn of the University of Washington and also an INET grantee. Thank you very much for joining us.
Thank you for having me.
So we wanted to talk to you as a sociologist. How do you think of economics and what attracted you to the field in the first place?
That's a great question. So as a sociologist, some of the deepest, most fundamental theories that generated sociology were concerned with the economy and economic change. So if you start a sociology grad program, chances are you're going to take a theory class where you're going to be reading Marx and Weber and Durkheim. Scholars were deeply grappling with what does it mean to think about how society is changed by the ways that we order exchange. So for a long time, sociologists, though, focused on only a small part of the economy. So looked at production or labor and kind of stopped looking at finance or thinking about kind of their role as theorizing markets as a whole. But starting in the 1980s and 1990s, there's been a real resurgence of sociologists kind of returning to those original questions and understanding the role of sociology as having something to say about economic life and approaching economic life simply as, markets are something people do. They're something people do in groups, and so we can take all the knowledge we have about social life and people and bring that to our analyses of markets.
So in your research proposal that INET is now funding and you are conducting the research, you are going into federal credit programs. Why was that an area of focus for you?
So it grew out of an earlier project where I was looking at the history of mortgage securitization. And what I found was that in the postwar era, the federal government had been using securitization to bundle up and sell off loans. And that, in fact, the Johnson administration had moved to sell off $30 billion of loans in the 1960s. And that got me thinking, why is the federal government sitting on $30 billion of loans, another $70 billion of guarantees at this time? That's not what I thought the federal government did. That's not what I thought the federal government's role in markets would be. So that kind of seeded my interest in this. And what I found as I started looking into it was that it was this massive network, and that systematically since 1916, the federal government had been in the business of arranging how credit markets work, buying and selling loans, guaranteeing loans, working with people to seed certain kinds of innovation. And there are many, many examples we find. So it was just fascinating to see. And then it was also fascinating to think about because the field of sociology and economic sociology has been very much influenced by the work of Karl Polanyi and the idea that advanced capitalist markets are projects that the state makes possible. That in fact, government actors and private entrepreneurs work together for kind of successful, thriving markets.
And so if you bring together what you were saying about the original sociologists and what the questions that drove them, and now you are thinking about the role of the state in credit creation, where do you think were the greatest innovations in the 20th century? And you talk about 3 stages in your proposal about when there was a little bit of an evolution and how the government got involved in the market. How do you think about that?
Yeah, so if you look at these credit programs, what you see is that the federal government is throwing its resources behind favored areas of the economy. And it starts with farming. And in the post-war era, there's a lot of credit support for housing. Housing displaces farming as the #1 area of credit support. And then by the time of the 80s and 90s, you start seeing this rise in school loans and school loan programs. And in fact, school loan programs were just poised to overtake housing programs as the #1 sector receiving credit support before the housing crisis caused another massive resurgence of government support of housing that was often done through credit.
On that point, what do you think about the notions linking, the priorities of the government with, this idea of property owning democracy in in the post-war? And so trying to link people to housing as a way to anchor expectations in society at a time of huge demographic boom in America.
Yeah, so the way I think about that question is that Once we understand that markets are projects that government officials and private entrepreneurs work on together, we need to both understand what the needs are of the market that government officials are responding to. We also have to understand the everyday experiences of government officials that's affecting what they do. And the main everyday experience of government officials that they have to grapple with is the demands of budgeting, of having to try to help markets without raising as much as they possibly can in taxes. And so credit, once they figure out credit as a tool that they can use to help the economy grow, they start using it all over the place and aggressively. And you see early on with housing, for example, that with the New Deal housing programs, they figured out very, very quickly that if you build a house, you don't just support the housing sector, you support every sector. You support the tools and the lumber and the kind of natural resources that go into a house. You support shipping and transportation industry. You create jobs. And then those homes are the shells that Americans fill with stuff, and that kind of drive American consumerism in the post-war era. So they're very aware that housing has these incredibly generative effects for the whole economy, and that by giving a loan for housing, or even better, by guaranteeing a loan for housing, they can support the whole industry with spending very, very little money.
Where do you see that we've made mistakes along the way? Because obviously from certain ideological perspectives, you could argue that there's been too much intervention, right? Mm-hmm. And mismanaged incentives. So if you think about it from the perspective of the crisis and now and everything that happened in the housing sector, where do you see that we were human after all?
Yeah, so from a sociology perspective, we're always already human.
Right.
So a lot of the things that happened with the crisis really made sense with our theories.
So what do you think were the classic examples of what we did wrong?
So the idea that there's that markets run themselves and can run themselves without regulation is an idea that stops making sense once you see markets as projects between markets and states. Right? The question is not to take away government regulation of markets, because many of those regulations are institutions that have developed over long periods of time to solve problems. It's actually, you're stripping away generations of learning about how markets work. You want to keep regulations in place and keep good regulations in place. So I think one of the kind of big lessons of human after all is recognizing that because the markets are part of social systems, they're political, they're cultural things, pretending that they're not doesn't help us get to the right answers. We have to start from the recognition that they're social and cultural and political, and then have a real honest account that builds from there.
Right. You've done a lot of sociological research. I've looked it up. And sort of trying to see how people's perceptions change. Mm-hmm. Do you think that is in this area, as you build your data set of the historical size of the government involving in housing and federal credit programs, do you see that after the crisis there's been a change in perception? Do you feel that occurring?
Absolutely, absolutely. And what you see is that there's an incredible willingness for people to take account of other ways of looking at the market and of the importance of the state and things like that, and that categories are definitely shifting. And I think here it's a wonderful time to have more of a dialogue between sociology and economics, mm-hmm. because sociologists have been spending, that's the bulk of what we do, is to think about how categories of understanding change over time and with social positions.
If we think about mortgages specifically, do you think there's weight to this notion that this association between the originator and the ultimate holder of the mortgage created an inherent problem in the distribution of risk? And so there was a clear incentive for originators to originate as much as possible, whereas because they were not going to have, quote, no skin in the game.
Yeah, and I think we're learning the challenge is to try to figure out how to allow for social distance between borrowers and lenders, mm-hmm. in ways that are more kind of carefully measured out. The danger with risk management technologies and the kind of conceptual danger is So you develop a tool to help you manage risk, to help lessen risks so that you can improve how the market's working. The danger with that tool is thinking you've got it actually all figured out. And once that happens, we're in really big trouble. And that moment of thinking we have it figured out is forgetting that these are ongoing social systems that are constantly changing. We can't ever have it all figured out because risk isn't an abstract thing that exists outside of people. And if we just come up with the right formula, then we've got it cracked and then we have to stop worrying about it. Credit relations are social relations. They're obligations between people. And the second we figure out a new technology, people respond to that in very complicated, complex ways. So I think what we're learning is how to pay attention to how economic changes kind of ripple through the social world.
So you see a notice, or you notice a change in society, and you notice a change in perceptions toward credit and toward federal credit programs. Do you notice any evolution in the way we write the legislation, or that we try to, go back to regulation? Is it being efficient, or are we failing?
Yeah, that's something I think about a lot.
Right.
Because we have learned a lot, and we know a lot about how to keep markets on track. Here's what we don't know, which is we know what to do, and there's a lot of popular support when markets are bad for the government to step in and help stabilize things. When things are really, really good, years down the road, and everybody's forgotten the last disaster, except for a group of historians, how do we make regulations that hold up to the pressures that arise at that moment? I think that's what we haven't figured out.
So we need good historians.
We need to all listen more to good historians.
That's great.
Yeah.
But do you think that in the years since the crisis, that regulation has been moving in that direction, in the sense of sort of recognizing that there had been mistakes in the past and sort of trying to address that with efficient tools that, as you say, can evolve to sort of take account of new technologies and new behaviors and the way that markets and people interact? Yeah,
and I think, for example, new regulatory bodies that recognize that you have to review economic technologies to see how they affect people and kind of and think about them more broadly. I mean, that's an important step forward. And I think it's a really generative time where a lot of interesting proposals are coming up for what we can do. And an idea put forth by some people, including, I'm thinking here of David Moss's work, which is once we recognize that the government's always going to step in a time of crisis, we can plan for that. We don't have to wait for the crisis to come. We can ask everybody to, say, pay in ahead of time for social insurance, for that kind of insurance.
Right, the way also some people have been arguing that banks should contribute, at least in Europe, they're contributing to the same resolution mechanisms that they'll be used to wind them down in the future.
Exactly.
So you are trying to preview the crisis before it happens and the tools with which you deal with it.
Exactly, and what you see is an honest accounting of the actual role of the state with the market lets us have a more full discussion of what's actually going to happen when a crisis comes. But if we can't have a real discussion about what the government's actually doing and how important the government is through things like credit programs, we're really limited in the kind of solutions we're going to be able to imagine.
So let's talk a little bit more about your research project and how are you going about finding the data to plug in the gaps that we have currently of the understanding of how credit programs have grown so much over the last almost 100 years.
So right now we're just gearing up and we're starting with some existing work by a group of scholars that went up to 1953 that had a great review. So we're kind of digitizing their work and working back from information available through the federal budget. And there are some sketchy years, the 1950s and 1960s, that we're going to be getting to next that are going to pose the real challenge. And I'm hoping that by going to the National Archives and looking at budget files, it'll make it. We'll find new sources that help us explain what was going on.
And people think that this is abstract and it's federal programs for credit, but in your proposal you describe so eloquently how this is actually a real huge asset pool that is in the economy and that is directed by the state and has real impact on GDP. So we're talking about trillions of dollars. right?
Yeah, it's massive, and it's been there so if you look at if you think of the modern federal government in the US, starting in the progressive era, we have the credit programs being there too. So we have, in the US, we have a kind of a long history of the government it's massive, it's always been there, it's hit every sector of the economy. There's kind of no sector of the economy that hasn't benefited from it. And I look in the US and focus on the US, but there's evidence that this happens in other places too, which raises a really interesting question, which is that the allocation of credit in sectors of the economy might just be something that modern states do.
Right, and there's very lively debates, at least in the United Kingdom, about how the state is getting involved in guaranteeing, certain housing programs and mortgages. And so the experience of having the US and your research map out the growth of these programs is the first stage to having a real debate about how we use this tool, how the state is accountable, and how markets are accountable for interacting with the state. So last question, promise. We always try to think about a little bit more in abstract, the different type of people that come to INET and take advantage of INET's programs, resources, and the funds for research and for pushing forward new thinking. But on a personal level, if you had to describe what new economic thinking is to you, what would it be?
What do I think new economic thinking is? I think it is taking a fully holistic account of economics. And by that I mean situating our understanding of market transactions within a broad model of the broadest model we can imagine of what people are, how people think, creativity, morality, recognizing that markets are moral systems, political accountability, social inequality, putting markets in perspective as part of people's whole lives, and therefore we can draw from all sorts of academic disciplines and making sense of them.
Well, Professor Sarah Quinn, thank you very much for joining us, and good luck with the rest of your research. Thank you for being with us at INET, and we really look forward to your research. I personally think it'll fill a great gap that we have in our understanding on one of the most important things that the federal government does, not only by size, but also by how it affects real lives of many, many real people. So thank you very much for joining us.
Thank you for having me.